Enrique Abeyta claims Nvidia is about to crash, and as a result, a select few stocks could turn a $1,000 investment into $1.4 million. I reveal the 3 stocks Enrique is pitching here for free, so you don't have to buy his newsletter. Keep in mind, no paid or proprietary information is being given away. This is all based on clues from a publicly available sales presentation. There's multiple stocks to uncover, so we're just going to jump into things. Here's clues for the first stock. Enrique says, the number 1 stock for Trump's AI infrastructure boom. You see, during the internet build-up in the 1990s, some of the biggest gains came from companies that were building the internet infrastructure. For example, look at internet networking and communications equipment firm Juniper Networks. In the 1990s alone, shares jumped an incredible 2,600%, enough to turn $1,000 into more than $27,000. He continues and says, shares of EMC Corporation, which makes data storage software and equipment, went much higher. It exploded high enough to turn a small stake of $1,000 into more than $1.4 million. And then Enrique says, now of course, these gains were some of the top winners during the internet build-up in the 90s. But my point is, I believe history is repeating itself. But instead of fiber optic cables and internet routers, the boom will happen in AI data centers and all the equipment they need to operate. You see, Elon Musk isn't the only one investing in AI infrastructure and these supercomputers. Big tech firms have already invested hundreds of billions in computer power. And then Enrique talks about the company he's pitching and says, in fact, President Trump just announced a $500 billion new AI project called Stargate to build 20 new AI data centers with supercomputers across America. And I found one little-known company at the center of this AI build-out boom. It provides all the specialized cables and equipment these supercomputers need to operate. Elon Musk's supercomputer Dojo is using this company's products. So is Amazon and Microsoft. Last year, sales jumped 63%. This year, management is expecting sales will double. Sales are already booming. And I'm only expecting them to accelerate, which is why Bank of America recently released a note to its clients upgrading this stock to a buy. This sounds like Super Microcomputer to me, and the ticker is SMCI. Super Microcomputer is a US-based company that designs and manufactures high-performance server and storage systems, with a focus on energy efficiency and customization for data centers, AI, cloud, and edge computing. Here's the top 5 things to know about SCMI, and after I'll tell you if I'd buy. First is AI and liquid cooling equals high-growth catalyst. Supermicro is riding the AI and data center wave, especially with its liquid-cooled GPU servers optimized for Nvidia chips. They've secured deals recently with xAI/Tesla and rolled out high-performance AI/HPC systems. Plus, analysts like Raymond James say SMCI is in a sweet spot between Dell and HP in the AI server market. Second is guidance cuts and order delays equals volatility risk. Q3 FY 2025 revenue topped $4.6 billion, up 19% year over year, but sequentially down 19%, with gross margin slipping to approximately 9.7%. Management admits some customers are delaying platform decisions, which hit both Q3 and guided Q4 results, sending the stock tumbling approximately 6% on weak guidance. Third is big ambitions versus reality. FY25 and FY26 outlook. For fiscal year 2025, revenue guidance was lowered to approximately $21.8 to $22.6 billion from an earlier $23.5 to $25 billion. But the kicker, they project FY 2026 sales around $40 billion, well above consensus, $29 billion, leading to a 9.6% stock jump. High growth potential, sure, but it's forward-loaded and unproven. Fourth is accounting red flags, auditor drama and regulatory probes. Last year, SMCI faced scrutiny from Hindenburg, triggering EY's auditor resignation and DOJ SEC subpoenas. They've since hired BDO, published their 10-K with admitted control weaknesses, and are rolling out improvements. Still, governance remains a watch point. Fifth is geopolitical and tariff pressure. With manufacturing in the US, Taiwan, and Netherlands, Supermicro faces trade tension exposure. CEO Liang cited economic uncertainty and tariff impacts as part of the reason for slower customer decisions. On the flip side, having significant US operations is seen as a buffer in some analyses. I like Supermicro and think this stock is in a good range to buy right now. Let's look at the second stock now, which Enrique calls the $10 million AI power play that's set to skyrocket. He goes on to say, you see, President Trump has designed his entire energy policy to power AI. As he said, with US energy dominance, we will win the battle for AI superiority, which is key to our nation's prosperity. And I found the company that I believe will be the primary beneficiary of this policy, because it's providing energy to several AI data centers across America. I recommended it to my readers in another research service back in February of 2024 as a long-term play. And then Abeyta claims when he originally recommended this company, it was not even listed in any major exchange, and claims, Less than 6 months later, the company announced it was getting listed on the Nasdaq. On top of this, Enrique shows a chart of the stock growing 260% between March 2024 and February 2025, and he mentions this company has a market cap under $10 billion. Based on these clues, I believe Enrique is talking about Talon Energy, ticker TLN. Here are the top 5 things to know about this company. First is big power moves with Amazon. Talon Energy recently made headlines by securing a huge long-term partnership with Amazon Web Services. This deal locks in nearly 2 decades of stable revenue from its Susquehanna nuclear plant, providing electricity directly to Amazon's data centers. This partnership not only solidifies Talon's revenue stream, but also highlights the growing demand for reliable, carbon-free nuclear energy in the tech industry. Second is stock flying high, but be careful. Shares of Talon Energy have been soaring lately, reaching new highs and capturing investor attention. Analysts remain positive overall, but the rapid rise has pushed some indicators into overbought territory. So while momentum might carry it further, you should expect volatility and possible short-term corrections. Keep your timing in mind. Third is debt, the elephant in the room. Here's where things get tricky. Talon Energy carries a significant debt load, totaling billions, resulting in a pretty high debt-to-equity ratio. Its earnings currently provide just enough coverage for interest payments, but rising interest rates or any downturn in performance could put pressure on its financial health. That means investors need to closely watch Talon's ability to manage and eventually reduce its debt. Fourth is returning money to investors. Talon's management is actively rewarding shareholders through sizable buybacks funded by robust cash flows. They've already begun repurchasing shares, showcasing confidence in the company's future. This move signals financial discipline and can potentially boost earnings per share, making Talon attractive for long-term investors who appreciate shareholder-friendly policies. And fifth is clean energy shift, with a catch. Finally, Talon is transitioning its energy mix to cleaner sources by gradually converting or retiring its coal plants in favor of gas and nuclear. While this aligns with ESG investing trends, the transformation relies heavily on subsidies, regulatory support, and the capacity market. If political winds shift, Talon's clean energy transition could face headwinds, creating a layer of policy risk for investors to keep in mind. Talon probably has a bright future ahead, but I would wait for a dip in the price to do anything. The stock is very expensive right now. The last stock being pitched is Taiwan Semiconductor, and this is actually the main stock being pitched in this presentation. This is such a well-known stock that I don't think it's necessary to make you look at all the clues Enrique left, but I'm 100% sure this is what's being pitched. Here are the top 5 things to know about this stock. First is geopolitical tightrope. US-China tensions reshaping strategy. TSMC finds itself at the center of escalating US-China tech rivalry. Taiwan's recent export controls aligning with US sanctions further restrict TSMC's dealings with Huawei, though the company had already self-restricted due to US tech bans. That said, these moves realign TSMC's focus toward more geopolitically stable customers in the US and allied markets. Meanwhile, its US fabs in Arizona are up and running, and the roadmap for 2-nanometer chips by 2028 is intact, though slightly behind Taiwan's schedule. The takeaway? TSMC is navigating political storm clouds while de-risking its chip supply chain. Second is AI-driven growth. Demand heading through the roof. AI chip demand is the rocket fuel powering TSMC right now. At its annual meeting, CEO C.C. Wei said AI-related chip revenue is expected to double in 2025 and grow about 45% annually over the next 5 years. Q1 showed a staggering 42% jump in revenue, marking its strongest surge since 2022. Analysts see this as a long-term secular trend. Growth forecasts call for 41.5% revenue expansion in fiscal 2025, followed by roughly 16 to 17% in 2026 and 2027. If AI continues to dominate, TSMC stands to be the primary beneficiary. Third is earnings and dividends. Heavy cash flow backing capital returns. Expectations for Q2 earnings remain high, with EPS forecast at $2.32, a whopping 57% year-over-year gain, and revenue around $30 billion, a 44% rise. TSMC just approved a new Taiwan $5 per share cash dividend for the first quarter of 2025, with plans for steadily increasing payouts. Despite huge capex commitments, around $38 to $42 billion this year, TSMC maintains strong liquidity. Liquidity to uses ratio sits at 2.2 to 2.4 times. In short, they're pouring money into growth while also rewarding shareholders. Fourth is capex spine. Massive investments with execution risks. TSMC's aggressive spending is core to its competitive moat. Between 2024 to 2025, it is sinking around $38 to $42 billion into fab expansions, dwarfing competitors like Intel. Investments include new 2-nanometer fabs in Arizona and a major €3.5 billion factory in Dresden, Germany, plus the Japan Advanced Semiconductor Manufacturing joint venture. While this secures long-term leadership, challenges persist. higher costs for US fabs, up to 50% more than in Taiwan, talent shortages, and tight project timelines. And last is tariffs, currency, and margin pressures, hidden headwinds. While US semiconductor tariffs have been mostly avoided, they're still looming. Importers bear immediate impact, but any hit to customer demand could trickle down to TSMC. Currency fluctuations are another drag. An appreciating Taiwan dollar has already shaved over 3 percentage points from gross margins. Cybersecurity threats and political instability across the Taiwan Strait add layers of unpredictable risk, highlighting the fragile geopolitical environment in which TSMC operates. I think TSMC is a good long-term stock, and if you think AI is going to keep growing, this is a good stock to bet on that. And don't forget to click the link in the description to check out AlphaPick. Right now they're running their biggest sale of all time, and you can get $100 off this amazing service. Remember, I've reviewed over 100 stock picking services, and this is the only one that consistently beats the market, nearly tripling the returns of the S&P since inception. So again, make sure to click the link in the description and get $100 off this incredible deal.